Hello investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. By popular demand, I'm looking at ironSource today. So ironSource is a business I'm particularly interested in, and I've highlighted before that I own its peer, Digital Turbine. So I kind of was quite interested to find out what's at play here. So I'm going to go through and attempt to discuss what its growth prospects are, explain a little bit about what ironSource does. Then I'm going to talk about its profitability profile, and finally I'm going to talk about its valuation. So at its core, we have a mobile gaming app platform. So it's a platform that allows the developers to better monetize and make their apps more discoverable. So as you know, making an app is quite easy, straightforward, and how you get that app monetize is really, what defines a successful app, really. So gonna go through that, but I get a bit ahead of myself right now. So here's the thing, right? The revenue growth rates are a bit kind of all over the place. So you can see that coming out of Q1 21, they grew at 96% year over year. Then you fast forward to Q4, and the guidance is pointing towards approximately 33% year over year growth rates. So for a business to be growing at the start of the year close to triple digits, and then it kind of does this IPO, and now it's kind of like, I know it has a lot of buzz, this company, but I'm kind of like, it's going to be difficult. And you have to also keep in mind one thing. When we come around to Q1 2022, they're going to be up against Q1 of this year, where they grew at 96% year over year. So it's going to be a really tough comp to come up against. So with that in mind, I think, it's difficult to kind of get a sense of what the sustainable growth rates are going to be here. Okay, so that's one of the things that I wanted to highlight. The other thing that I wanted to note is that what the business model, how it compares with other players in the industry. Okay, so you're on the one side, you have a creation platform, which is like Unity. Okay, so that kind of is the engine to create the app. On the other side, you got the content players like Zynga. Okay, so to provide the infrastructure, you got ironSource. Okay, that kind of allows, as I described already, it's how to get that distribution and how to get the monetization of the app going. Okay, it's the tools that allows for that. So if you divide up ironSource, it has two main operations. It's got the Sonic business and the Aura business. Okay, the Sonic business is the bigger business. That's the one that we're going to focus on right here. Okay, so that's driving user growth for the app, analytics, monetization. Okay, so this is aimed solely at developers. Okay, developers want to drive success of their business. They want to drive monetization, and ironSource takes some usage-based revenue from that. Okay, so the more successful the app, the more that it drives the revenue for ironSource. Okay, on the other side, the business, you got Aura. The Aura side of the business is aimed at telcos. Okay, so let's say a telco wants to drive the adoption of content from their on owners' devices. They would reach out for something like ironSource. Okay, so ironSource is really aimed at the Aura segment is really aimed at telcos. Okay, how to improve the experience for the phone's user. Okay, and as I already alluded to, okay, so it's a very high net expansion rate. You can see here for Q3 21, it reached 170%. Now, obviously, if you got a usage-based model and you are setting yourself up to be a beneficiary of apps that do well, you're going to have a high expansion rate. Okay, so that's the ability to really see year over year how much more revenue derived from certain customers. Okay, now one thing I wanted to highlight here is that it's important to have an expansion rate, and typically in the SaaS world you're kind of looking at approximately anything above 110% as being attractive. So at 170%, you obviously have a very, very sticky customer base. That's really, really one of the best things about this business model. And if you have a sticky customer base, you're obviously going to have high profitability margins, and the profitability margins are very good. They're approximately 36% for Q4, and it's kind of been around that for the whole year. So as I explained, if you got a sticky business model, you have high expansion rates, you have high profitability margins. So that is not going to change as we go into 2022. What we need to try and ascertain, which is difficult, is what the growth rates are going to be. So analysts following the stock expect that the company is going to grow approximately 32% year over year into 2022. But let's say that analysts have been too conservative, okay? Let's say the business grows somewhere in the ballpark of 35 to 40% CAGR. That implies we're kind of getting close to 740 million of revenues for 2022, okay? At 740 million, that puts the stock trading at 13 times forward sales. That is not expensive if you think about EBITDA margins of, mid-30s. It's really, if you look at other businesses that have these kind of high EBITDA margins, you're getting much higher multiples than this. So it is clearly attractive. But as I alluded to at the start, I own Digital Turbine, so this is only for entertainment purposes, it's not a financial advice, but for reference, where it overlaps with each other is in the life cycle side of the business. So Digital Turbine makes a lot more of its revenues right now from pre-installs. It will, over time, increase its exposure to the life cycle of the phone, and that's where it overlaps. ironSource doesn't really overlap that much in pre-installs. It does have a little bit, but Digital Turbine really dominates that part of the business, that part of the market. And let me preempt your question, because I know that everyone says to me, Digital Turbine is okay, but the gross margins are really, really thin. Okay, so the Digital Turbine's EBITDA margins were 15% for last quarter. So to make it like for like, I will do that in a minute, but just let me take a step back. Digital Turbine is priced at approximately 3 times next year's revenues, okay? 3 times. Now, obviously, ironSource has 35% EBITDA margin, so to make it kind of like for like, on a comparison basis, that would put Digital Turbine priced at 7 times forward sales. Now, there is a big question mark out there, which is, can Digital Turbine grow at approximately 15 to 30%? The analyst day, that's exactly what the company points towards, 15 to 30%, but they're really trying to work very hard to expand the EBITDA margin. So it's up to you whether you decide that or not. I think that ironSource is an interesting business. I think that there's a lot going for it, but I'm not sure that paying 13 times forward sales, when you have all that volatility in the revenues, is that attractive. When you got a peer which is also growing at a similar rate, perhaps a nudge slower, but priced at approximately half the multiple. So with that in mind, if you want to find out what kind of stocks I'm buying right now, don't forget to check out my marketplace. It's called Deep Value Returns. I help you become a better investor, and you can check out what other people have said in the reviews to see if this suits you. Okay, thank you so much for listening. Bye.